Cory, what are the three key differentiating points from the Barrow Hanley approach?
First and foremost, we're buying good companies that are down for reasons we can identify and believe to be temporary. And when we say good, these are companies that have had historically competitive rates of profitability, like return on equity. They've been good capital allocators, return on invested capital that we can measure. And generally, most of the time, they've had good earnings per share growth rates in line, if not better than the market. So we're buying companies that are value in terms of valuations with pretty competitive profitability rates. And so when you combine those two things, cheapness and above market profitability, that's going to equal alpha. That's the first thing. That's different than some deep value managers are buying much more distressed companies with balance sheet leverage and other things hoping for a turnaround. The second thing is by building the portfolio of both cyclical and defensive names, we're keeping you in the game year after year. And so that's also a little bit differentiated. So as a traditional value manager, our goal is to avoid these boom bust cycles between defensive and cyclical names that many value managers have. The last thing, and I think is a really key differentiator, is we spend an enormous amount of time on downside risk, almost like an insurance company. So in our business, you ask a typical analyst, okay, they're focused on the price target. I got 50% upside to my price target, and we say, okay, what's the downside? Oh, well, I don't see this. The stock can't really get any cheaper than it is. And we say, okay, that's not right. What is the downside? Well, maybe 10%. Well, we know that that's wrong. And so what we do is we look at every name that we include and that we're holding, and especially names that are coming in, almost like an insurance company. Do we understand the risk? We know we're going to be wrong. We just don't know when we're going to be wrong. So there's going to be a hurricane or a typhoon, but you don't know when. But when there is, how do you judge the risk? So we know we're going to be wrong. If we're wrong, how bad can it get? Stress it to the GFC, stress it as hard as you can. And if it gets bad, do we have the balance sheet to withstand the cycle? Can the company survive? And understanding these risks, are we paying the appropriate price for the amount of risk we're taking on? And then once we determine all that, we think about, is the position size appropriate for these risks that we understand? And so that is very different than a lot of value managers.